President Trump says a new trade deal with China is possible, touting his great relationship with Xi Jinping. Stocks in Asia drift lower. Donald Trump steps up his attacks on Ukraine's president, saying Volodymyr Zelensky is doing a, quote, terrible job, as the US pressures Kyiv to accept a deal to end the war.
Hello and welcome to The Week Ahead on Nomura Podcasts. I'm your host Andrew Ticehurst from our Global Markets Research team, and today's Friday the 21st of February. Well, market sentiment seems to be holding in pretty well as this week comes to a close. Equity markets are generally holding up at healthy levels, credit spreads remain pretty tight, and commodity currencies, which are often seen as global growth sensitive risk barometers, are holding up at higher levels too. Globally, it would seem that Russia-Ukraine peace hopes are still higher than they were a few weeks ago, while tariff-related fears have subsided somewhat, at least for now. One newer and additional positive development revolves around China, with President Xi hosting a summit with China's top tech entrepreneurs. And that might seem to endorse the importance of the private sector and could potentially revive some animal spirits and economic nationalism there. While that latter story could have legs, the best strategy might be to enjoy the party but stay close to the door. We think markets may have become too complacent over Trump's America First policies, and as his April 1 deadline for the completion of a wide range of investigations creeps closer over the next few weeks, nervousness could certainly return. Elsewhere, it's not entirely clear that a US-Russia peace deal over Ukraine is necessarily positive for Europe, and there's certainly uncertainty around future European defence spending and risk around Germany's elections this weekend too. So this week, I'll be checking in with some of my colleagues around the globe to discuss some of these issues. We'll also be watching out for a couple of central bank meetings along with key inflation data. Let's dive in. So, starting with the US, and I'm joined here by Jeremy Schwartz from our New York-based research team. Jeremy, let's start with the core PCE inflation data that's coming at the end of the week, probably the highlight on the data calendar. What are you looking for there?
Sure, Andrew. Great to be back on the podcast. Based on CPI and PPI data, we're expecting core PCE inflation rebounded to 0.274 month on month in January. So that's a bit of a sequential pickup from the 16 basis points or so it rose in December. But that said, this is a lot lower than we've seen in past Q1s. So inflation has tended to pick up to start the year since the pandemic. And I think most folks in markets as well as Fed officials were expecting a similar increase this time around. So you did get a bit of that sequential acceleration, but the year-on-year reading is actually likely to fall quite significantly. We think year-on-year core PCE should get back down to around 2.6 and continue making progress through Q1. So again, not a great inflation print, but probably one that the Fed will think marks further progress towards their target.
Okay, good one. And switching from inflation to growth, I see we've got some revisions to Q4 GDP coming too. So I just wanted to ask big picture, how is the economy tracking through Q4 and what's your take on growth momentum as we move through Q1 here?
Yeah, so we think that the Q4 real GDP growth reading is probably going to get revised down modestly to something like 2.1 from the initial print of 2.3. That said, the growth data to start the year has been a bit more interesting and shown a bit of a steeper deceleration. Notably, we had a big drop-off in retail sales for January, something that we had been expecting to start the year, although coming a little bit sooner than we had anticipated. In our view, a lot of spending late last year was likely just consumers pulling forward demand ahead of potential tariff-driven price increases and maybe some opportunistic shopping around holiday sales. We're seeing that beginning to unwind now. We've seen some less optimistic guidance from retailers here. And beyond just the consumer, there's also some evidence that housing momentum is slowing as well. So nothing seems to be falling off a cliff. It's not a catastrophic growth outlook, but we do think that momentum acceleration late last year was mostly a false signal, and that momentum continues to cool.
Okay, got it. So continuing growth, but maybe just a little loss of momentum. And finally, Jeremy, thank you. While I've got you, I just wanted to check in and see what your latest thinking on the Fed is here.
Yeah, so most Fed speak recently has pointed to a consensus that policy should stay on hold for now, that they still need to see a lot more progress on inflation, and that there's a lot of uncertainty about the potential upside inflation risks from Trump's policies. One interesting development over the last couple of weeks, though, is that aside from the regular policy rates, there have been some relatively quick moves on bank regulation, as well as a potential signal in the minutes that came out earlier this week that the Fed might think about an early end to QT, to balance sheet rundown. Notably, we hadn't seen this from Fed officials up until these minutes. They had continued to insist that reserves are abundant, that there was no real sign from markets that there was any stress or any possibility of stress. But the minutes talked about a more proactive risk management approach, particularly around the upcoming debt ceiling showdown, which can often lead to some confusion in money market data. There are big influxes of liquidity, which can then get very quickly drained out. And it can make it difficult for the Fed to gauge whether they might have overshot on balance sheet rundown. Again, we think this idea makes sense on the merits, but it comes as a surprise communication-wise and is a little bit inconsistent with what they've been signaling through last year. Notably, on the calendar next week, we've got an appearance from Dallas Fed President Lori Logan, who's often seen as a thought leader on balance sheet policy. Any confirmation from her that this is kind of top of mind for the Fed would likely accelerate the market's expectations for when the Fed would pause or potentially end QT.
Okay, got it. Bit of a technical one, that one, but really appreciate you coming on to the podcast, Jeremy, and explaining that one for us. Thanks again.
All good.
In the past few days, I was in Munich last weekend, and I feel like you've seen a big shift in Europe stepping up. Europe is coming closer together, and sometimes at these times of, crisis, if you could call it that, that people find a way to come together.
Now, let's jump across to Europe, and I have Andrej Stepaniak from our European-based research team here with me again. Hey, Andrej, how are you?
Hey, Andrew, very well, and yourself?
I'm well. Thanks very much. Hey, let's start with politics this week. We have the election in Germany, of course, this weekend, and it looks very interesting from my distance. Some of our audience will probably see some of the results before they might hear our podcast. But what's the expectation going in? And can you give us some context here? Why is this election such a big deal?
So first off, we're expecting a change in government. So if we recall correctly, the current government collapsed owing to disagreements over fiscal policy, and in particular the right-wing FDP, which is more of a fiscally hawkish party, were against any loosening of fiscal policy. And obviously that's in face of Germany's structural economic problems. So the new election, we are expecting that the CDU-CSU will become the main party. The question then is, what sort of coalition will we see? It's probably going to be some sort of grand coalition with the center-left SPD, as well as maybe the Greens as well. But generally speaking, it's a very pivotal election, as everyone's focused on the extent to which the new government will undertake what we call debt brake reform. And basically, it's a self-imposed limitation in terms of fiscal spending. And if they reform the debt brake, they're able to then essentially loosen the purse strings and spend somewhat. It's worth bearing in mind we aren't expecting too much. We are expecting the new government to only loosen the purse strings by about 0.3 to 0.5% of GDP, and for the debt brake reform to be carved out purely for government investment. But nonetheless, given Germany's problems, they've had contraction in terms of a calendar year base for the past 2 years. They need to do something to support the economy going forward. And this is really that pivotal moment for them.
Okay, got it. That is interesting. Hey, this week we've also seen some pretty fiery comments from US Vice President J.D. Vance with respect to Europe. I wanted to ask, how did those comments go down over there, and what could be the European response?
Look, it's all about defense. The idea that the US obviously believes they've done more than their fair share. They've essentially defended the European continent since the Second World War, and Europe isn't pulling its weight. If you recall correctly, most European NATO member states aren't spending the 2% commitment on defense of GDP that everyone's meant to. Obviously, the US is spending more than that. The response really has been quite pivotal in some ways. Now Europe is talking about three potential routes for increasing defense spending, knowing that the US essentially isn't in their corner, certainly under this administration. So the first thing they're talking about is joint EU issuance for defense spending. That's totally new and quite pivotal if it occurs. The second they're talking about is rerouting unspent NGU funding, so already allocated money that hasn't been spent yet, to defense spending. So that's quite pivotal as well. And finally, they're actually talking about suspending the EU fiscal rules and carving out defense spending from the excessive deficit procedure measures to allow national governments to issue more for defense. This really is a turning point in Europe's history on defense spending in that respect.
Yeah, wow, this geopolitics is just so interesting. But hey, look, we'd better just turn our attention briefly to the data calendar. We do have some European inflation releases coming out over the course of the week. That could be a highlight. What's your view on that?
I mean, look, obviously, in some ways, it feels like geopolitics is taking the front seat in front of them, all the data. But I think the data will be quite important as well. So it's inflation data, as you mentioned. From the ECB's perspective, essentially, we have the upcoming meeting in March where we think they will cut rates. Already, we've had some ECB speak, sort of try to set the stall for pausing or slowing the pace of cuts beyond the March meeting. And this inflation data could be pivotal as well, in the sense that if we see services inflation remain sticky, that'll give more of an argument to the hawkish members to sort of set out their stall and argue more strongly in favor of slowing the pace beyond March. So all eyes really are on the extent to which services inflation remains sticky, or if we finally see it ticking down as we expect.
Got it, Andre. That's brilliant. Thanks so much.
Thanks, Andrew.
Now, let's turn to the broad Asia region, and I'm joined here by Jeong-Woo Park, our Korea economist. Hey, Jeong-Woo, thanks for joining us and welcome back.
Hey, Andrew. Yeah, thanks for having me.
Excellent, thank you. Jeong-Woo, let's start with the Bank of Korea because I know that's one that's pretty close to your heart. So the BOK meets next week, and consensus seems to be that we will get another rate cut there. Do you share that view, and what's driving your thinking?
Yeah, we also think the BOK is going to cut the policy rate by 25 basis points. And I think this is going to be a unanimous decision. So basically, we expect the BOK to deliver a neutral rate cut, and that's a slightly, the relative to market expectation of hawkish rate cut. And in terms of its economic outlook, we expect the BOK to lower its 2025 GDP growth forecast to 1.6% from the current 1.9%. But I think they're going to raise headline inflation forecast. But at the same time, the reflecting weak domestic demand, I think the BOK is likely to lower core inflation forecast. So basically, they think that the inflation will remain under control.
Okay, got it. So a rate cut and a lower GDP growth forecast for Korea. Now, if I could get you to just turn your attention to the south, Bank of Thailand is also meeting next week. Do you know what is the team looking for on that one?
Yeah, our house view is that the BOT is going to deliver dovish rates hold because recently some easing financial conditions that's going to support rate hold, but we think there is some risk of the 25 basis point rates cut right after the disappointing Q4 GDP growth. And at the same time, the recently, and the government and the BOT as well, they are seeing a growing downside risk to the growth outlook, although our base case is dovish hold.
Okay, got it. So dovish hold with a risk of a cut. And we also had rate cuts in my part of the world, in Australia and New Zealand this week too. Okay, Jeong-Woo, that's great. Thanks so much.
Thank you.
Now, elsewhere across the broad Asia region, let's finish with a couple of quick highlights. First up, Japan. We're expecting core February Tokyo CPI to ease to 2.3% year over year from 2.5% previously, and that forecast is roughly in line with consensus. We also have industrial production in Japan falling by 1.8% month over month in January. That's a slightly below consensus forecast there. But elsewhere in Japan, we're noting some hawkish communication from the Bank of Japan and higher JGB yields and a stronger yen too. And our team continues to pencil in another 25 basis point rate hike from the BOJ in July. Next up, China, where we have seen a few positive developments recently. We expect the official manufacturing PMI to rise to 49.8 in February. That's up from 49.1 in January, so some improvement there, but just below the neutral 50 level. Our team is noting that China's emerging industries PMI did rise in February too. And they had the non-manufacturing PMI holding at 50.0 from 50.2, supported by travel and entertainment demand during the Lunar New Year period. And finally, India, we expect Q4 GDP growth there to pick up modestly to 5.8% year over year from 5.4% in Q3. Those would be dream numbers for a developed market economy, but our India team there are describing those numbers as a bit underwhelming. So, those are the views from us, and that's the week ahead, written by Andrew Ticehurst and the Global Markets Research team, edited and produced by John Dalton. Thank you for listening to our podcast. If you did enjoy listening to the show or want to hear more from Nomura's economists, researchers, or investors, please like and subscribe to Nomura's podcasts on Apple, Spotify, and SoundCloud, or wherever you get your fill of podcasts. If you are feeling generous, please leave us a review, preferably a nice one. And as we always say, it would make our day if you could press a few buttons and share this podcast with a colleague or a friend. For more, log on to nomuraconnects.com to keep up to date and to keep on listening. Thanks, goodbye for now, and see you next week.
In a complex and unpredictable world, where a sunset in one market means a sunrise in another, one investment bank always looks beyond the horizon to help our clients release the potential of tomorrow, today. Nomura, connecting markets, east and west.
Disclaimer. This content has been prepared by Nomura solely for information purposes. It is not intended to form the basis of any investment decision, and is not an offer or solicitation of an offer to buy or sell or enter into any agreement with respect to any security, product, service, including but not limited to investment advisory services or investments. The opinions expressed in the content do not constitute investment advice, nor is legal, regulatory, accounting, or tax advice, and may change at any time without notice. You should seek independent advice as appropriate for individual circumstances. For further information, disclaimers and disclosures, please visit Nomura Connects at www.nomuraconnects.com.